Recently, Didi plans to delist from the US stock exchange and may relist in Hong Kong. At the same time, the US government disclosed the final amendment of Holding Foreign Companies Accountable Act, HFCAA. After the announcement, the stock price of all US-listed Chinese companies fell sharply. It raises market concern about the future of those Chinese companies. Selina will explain more.
In 2020, Chinese government had tightened its grip on the tech giants and introduced new regulations for antitrust and data protection. As the largest Chinese retailing company, Didi brings regulator concern about leakage of sensitive data on travel routines and users. In June 2021, Didi pushed ahead with its US IPO without convincing authorities about having solved its cybersecurity issues. This act provoked a serious consequence. 25 of Didi mobile apps were quickly removed from the app stores. New user registrations were banned, and other Didi businesses were put under investigation. Didi then decided to delist to confront Chinese regulators, but by then, it may have already provided reasons for HFCAA amendments.
What is HFCAA and what are the new amendments?
After looking COVID's 4 data case, Chinese regulator repeatedly denied requests from the Public Company Accounting Oversight Board (PCAOB). HFCAA was implemented in 2020 by the Security and Exchange Commission, which is responsible for overseeing the audit of the Chinese company listed in US. The new amendments include banning companies to trade and/or forcing to delist from stock market if PCAOB is not able to audit their reports for 3 consecutive years. It also requires companies to declare whether they are owned or controlled by any foreign government.
Is there any contradiction between US and China, and what will come next?
China and Hong Kong are the 2 only regions that do not allow US regulators to inspect both. Currently, there are about 220 firms which are opposed to PCAOB inspections. The increasing regulatory challenges from both the US and the Chinese authorities indeed shows long-term risk of information asymmetry. The asymmetry makes Chinese companies are more vulnerable because of the different accounting standards, VIE structures, large holdings of major shareholders, and contradict between high revenue growth rate and poor operation cash flows. If the 2 parties cannot reconcile before 2024, these Chinese companies will face the risk of delisting. There are 3 ways of relocation if they plan to return to Hong Kong stock market. First, apply for listing in Hong Kong after privatization. Second, main listing in Hong Kong dual listing. Third, secondary listing. With China's stock market system reform, the stock board will also be another interesting option. The relocation will probably further disencourage Chinese firms to list in the US. Only small companies with thin profit margins or even loss-making may choose US as the main listing location. Whenever possible, we invest in companies listed in China and Hong Kong without the delisting risk from Chinese ADRs, for which the investor does not get compensated. In future, we expect to see more high-quality companies to be listed in Hong Kong or China.
That's it for today. Thank you for watching and hope to see you again in the next episode.